Hi there, Etoro. It's Monday, and that means it is time once again to see what happened in the markets last week. I wanted to start with this heat map. It's been fairly rough going for December and January. Typically, December and January are very good months for the stock market, but as we all know, that's not been the case this time around. So this is the one-day performance. The markets have just opened this Monday, and things are quite red. But if we look back 1 week, we can see a few patterns emerging. So lots of technology stocks getting hammered, a lot of the giants in the market, the mega caps coming down to earth a little bit. And if we go 1 month further back, we can see that that's definitely where the red is concentrated. So what the hell is going on? Well, I think we're still in a bit of that taper tantrum, that the market readjusting to the new reality. We got news from the Fed, and it was a bit more hawkish than was expected. And the market is now responding, repricing assets. As it does, it tends to go too far in one direction and will eventually have to come back. The selling in technology stocks we could see was particularly bad, but by looking at the NASDAQ 100, you can see how dire it really has been. Today, it really gapped down on open. And we saw in November, December, smaller caps taking a beating, and now we're seeing bigger companies giving a little bit something back. Again, I'm not too worried about this. It's good that everything is resetting a bit because we are still in an uptrend. You can see this channel that's been in effect for, years now, is still intact. We haven't broken the bottom bounds of it just yet. So we're in a little bit of an inflation / interest rate panic mode at the moment. Technology stocks are definitely being hit the hardest. Other indices are also down, but not by as much. We can also see that the yields on the US 10-year Treasury bonds has been in rally mode for quite a few sessions now. So this is a pretty enormous jump in a short amount of time for Treasuries. And usually, as we know from early last year, Treasury yields and technology stock prices tend to travel in opposite directions. And this is because this chart hints at the fact that interest rates are going up, and interest rates are bad if companies need to borrow lots of money to survive. And there are lots of high growth technology companies that don't make enough cash, they don't have enough free cash flow to survive. That's not the case for all of them. There are actually lots of good high growth technology companies that have a decent amount of free cash flow too. But the baby has been thrown out with the bathwater. That's how it goes. What I also wanted to show is that there's been a decent rotation out of growth stocks and into value stocks. So this is the daily chart, and it is showing the S&P 500 value ETF as the candles. And this is contrasted with the S&P 500 growth ETF. So this orange line that has been dropping massively for some time now, whereas value has been going in the opposite direction. So I just wanted to pull this up because it can be quite alarming in the moment when this is happening. But if you were to zoom out, even just a few months, you can see that despite the gains given back in growth stocks recently, growth stocks tend to outperform a value in the longer run. Now, this is just, half a year. If we go back further, we can see that in 2021, so February time last year, a similar kind of thing happened. We had growth stocks dumping, value stocks rallying, and despite this, growth stocks caught up and overtook them, although they've given some of that gain back recently. And the further out we go back, the bigger the difference is in favor of growth stocks. The reason for this is that a large number of companies that are considered growth stocks, those companies that grow very quickly, growing quickly is a nice thing to have, but also a lot of those companies are technology and software companies. Their costs of doing business are fairly low when compared to what are typically considered value stocks. And this means that profit margins are much higher, so they make a lot more cash if they're able to eventually become successful. Because they have more cash, they can grow more quickly. Because they're software, there are fewer limits on their businesses, and they can expand faster, but also become much, much bigger. So it's not just arbitrary that growth stocks outperform value stocks. It's not just some kind of a battle based on those particular titles. It's the types of businesses that fall into those categories and what that means for those businesses, the operations of those businesses, if they're able to be successful. Long story short, value, the traditional definition of value stocks, they are performing well at the moment, but in the long run, growth stocks tend to outperform those. Now, I'm going on traditional definitions because, in my opinion, you can have good value within growth stocks. So the definitions of these stocks, of what's growth and what's value, I think is a little bit malleable depending on who you talk to. In terms of what's going on in the indices, so they're all pretty bloody red today. You can see from the daily performance. Again, I call these indices, some of them ETFs, but we can see, for example, the Nasdaq 100 is down 2%. But I'm more interested in the 1 week performance. So the Nasdaq has taken the biggest beating, S&P 500 still taking a bit of a haircut, and the Dow Jones less so. If we look at the month view, it's a similar kind of story. So at the moment, we're definitely in the midst of this taper tantrum, this panic about interest rates and inflation, and it means that people are leaving tech stocks. And some of those tech stocks are way more expensive than they should be, but there are lots of tech stocks that are successful companies, that have good cash flow, that are growing well, and that will be successful days, weeks, months, and years from now. But, you know, the market lumps them all together, and once a sector is got a hell of a lot of negative sentiment driving it, that tends to continue. One stock, one company that I wanted to draw everyone's attention to is Discovery. So this is a decent example of the market being crazy about a particular company. So you can see the stock price went up to $75-ish at its zenith last year, and then the stock price has slowly trickled down. Now Discovery it looks as though they are going to merge with a spin-off from AT&T, so Warner Media, a huge media company, and those two companies together will be a behemoth when it comes to streaming, but also other kinds of content that people view around the world. The market has been worried about this merger for a few reasons, and I think that some of the reasons are incorrect. I don't think I'm the only one. The stock price has been dribbling down for a long, long time. And last week, as we get closer to the potential merger date, the stock price jumped massively. Now, one of the most amusing things that you'll see in the market is that when a company's stock price is dribbling downwards, you'll see a whole bunch of broker downgrades on the price. And that same company, when the price action changes, nothing else about the company changes except the price action, the same brokers will now be upgrading the price. You'll see this time and time again, analysts chasing changes in stock price action. So just bear that in mind and, you know, take what analysts say with a pinch of salt. I think that the merger is going to be fantastic for Discovery, and the stock could be much, much higher over the coming years. We're also seeing tales about Omicron. So the headlines are different depending on the geography. Of course, the UK has been pretty much unrestricted when it comes to coronavirus for some time now. But coronavirus is having an effect on all countries around the world to some degree. This means that we're seeing a weird mixture of optimism and pessimism. So, for example, the South African headlines and the UK headlines are quite optimistic because it looks like the disease is much less deadly than the Delta variant, and it has progressed through the population quite quickly. Whereas if you look at news about China, people are worried because of their particular policy, which tries to keep the number of cases at 0 instead of letting the disease run through the population. Speaking about China, so there's been a weird mixture of news recently. I have up on screen the candles, which are the Investec China Technology ETF, and this has continued its journey downwards recently. There's been a few different negative pieces of information out of China. I'll touch on them in a moment. But Alibaba has been going against the trend. I don't know if this is entirely because Uncle Charlie bought a whole bunch more Alibaba stock recently. But there is a trend that I've noticed over the years is that the highest quality stocks tend to bottom before the broader indices. So we'll see how it goes. I think this piece of news is weighing heavily on Chinese equities at the moment. The Chinese economy is heavily dependent on property development. And ever since prior to the Evergrande saga too, the Chinese government has been clamping down on a number of the dodgy dealings within the country. So a very large part of the Chinese economy is taking a hit, and that might continue for some time. The good news is that what the Chinese government is doing will make the sector of the economy a lot more healthy, but it might also slow things down. But on the flip side, we've also seen the Chinese government begin loosening up their economic policies, and they'll probably continue that, if the rumors are true, through this year. Okay, let's look at some of the root causes of the price action. I think I've mentioned a lot of them already, but the Fed has signaled that it's going to do a whole bunch of stuff that the market doesn't like sooner than had originally been anticipated. One of these is the potential for them to hike the interest rate 4 times through this year, which is huge. We already knew that they were going to taper quantitative easing, but the other bit of a bombshell is that they might potentially start getting some assets off of their books. When a government, a central bank, or a government begins to buy things within the economy, this means that they are putting more money, more liquidity into the market. And when they start offloading some of those things that they had historically bought, this means that other people need to use money to buy them, and it's reducing liquidity in the market. Theoretically, it depends on what they are buying and selling, of course. So these 3 pieces of information have terrified the market, because liquidity is not entirely what drives the market, but it is probably the largest contributor. I have already mentioned that Omicron is driving the market to some degree. That's no surprise. That's been going on for quite a long time now. And I mentioned that Uncle Charlie has dipped his hand a little further into his pocket and bought even more Alibaba stock. On the day of this news, if I remember correctly, the stock didn't move. I think it might have actually closed down, but there was a bit of a rally subsequent to that. Now, as I mentioned, there are many very expensive companies, usually software technology companies that were trading at very high multiples. They were expensive. These have now sold off aggressively, taking other companies that are also technology companies, but potentially fair value or cheap along with them. This is quite evident in the ARK Innovation ETF. You can see that it's dropped to new, is this more than 1 year lows? Yeah, so new lows since July of 2020. But as I said, the market overdoes this type of thing. If we take a look at a company like Mercado Libre, this has been dropping and is now nearly 50% of its recent all-time high. You could argue that it was quite expensive at this all-time high, but it's dropped a significant amount. However, this is a company that was growing very, very well. We're looking at a 43% 5-year CAGR on revenue, and EPS, net profit, has been growing very nicely too, and they will, if they hit their target, set a huge profit record in their next financial year. This is a company with very little debt, lots of cash on hand, very good at getting a decent return on capital and equity, and as you can see here, has been growing incredibly fast. Now, this stock price has also been affected by the political and economic situation in South America. A bit of a double whammy, but this is definitely massively overdone. This is an enormous opportunity, in my opinion. One of my favorite stocks for the next 1 to 2 years to hold. It's only in the stock market when something becomes much cheaper that people become afraid to buy it. Anywhere else, when things are on sale, people love to buy them. Here is a fast-growing, massively successful company, the Amazon of South America, and people are selling out of it in droves. It boggles my mind, but that's the way the market works, and that's how opportunities are born. Beyond this, what is the market telling us? Well, the time for speculative investments in technology are over, and value matters once again. There was a very frustrating period through, I guess, 2020 and part of 2021 for people that were valuing stocks based on the fundamentals, because fundamentals briefly did not matter, and companies that had no profit and in some cases no revenue and had no plans to have revenue or profit for a long time had stock prices that were soaring like crazy. Now, lots of those stocks are coming back to earth, and the market is a bit more rational. but only slightly more rational. Valuations do matter, but now they're selling out of good tech companies and just rushing after everything that's traditionally a value play. To highlight some of this craziness, I just showed you Mercado Libre on screen, but other e-commerce and online retailers, Amazon, for example, Coupang, their stock prices have been dropping for days, if not weeks, in some cases months now, and Q4 is the best quarter for these companies. So we're at the beginning of earnings season, and I will be particularly interested in seeing what the numbers that come out of these companies, because I bet that more than a few of those types of businesses have set new records in Q4 2021. There is a rotation in play at the moment. Money is moving from tech, growth kind of companies to value types of companies. Should we all be doing the same, trying to move back and forth and anticipate the market's moves? I don't think so. A similar thing happened last year, more than once, but there was an aggressive rotation between Q1 and Q2 of last year. But by the end of the year, growth companies were doing very well once again. And in fact, if we look at the data, because we should look at the data, we can see that in fact, when the Fed is increasing rates, it is usually companies within the technology sector that do the best. And this kind of makes sense, right? So I'll highlight this particular paragraph. So in the past 3 decades, there have been 4 distinct periods of rate hike cycles by the Fed. On average, technology, which has been under pressure amid prospects of earlier and faster rate increases, is among the best performing sectors during those cycles. The fact is that people are scared now because there's been selling for a while and they're worried about the economic context in which the stock markets are operating. But actually, when things settle down a bit, they will go back to their tables and screens and remember that technology companies are where the largest profits are, where the fastest growth is, and therefore where there's the most money to be made. So even though it hurts a little bit to sit through these drawdowns and these red days, very red days, especially when they go on for a while, you shouldn't worry about it too much. Look at history, see how the market behaves during these periods, and try to be confident in your investments. If you know what you own and they're good companies, they're going to be fine. So what about the week that we are currently in? It's Monday. The markets have opened generally down and quite red off of the back of a spike in Treasury yields. I think this week is not going to see anything particularly special. It's going to be the same as most weeks. The media and investors are going to follow information with regards to the virus, inflation, interest rates, and GDP numbers. We should also try to be one step ahead of the rest of the market. I've been saying this for a while now, but earnings are coming up. So just remember that that is happening. And I've got a feeling that volatility might die down a little bit as we get closer to earnings, as people try to take advantage of stock prices that have been hammered for companies that will do very well through Q4. Something else to consider is that we're not there yet, but we're approaching spring. And the virus the current variant has made its way through a number of countries. And as the weather begins to get warmer, people will start planning travel for holiday and potentially also for business. So I think that through the next 2 quarters, we should see an uptick in things like travel stocks, but also any stocks related to travel stocks. All right, that's it for this week. Don't worry too much. It'll be okay. And I will speak to you soon. Goodbye.